I actually look at all oil and gas companies, large ones and small ones. Right now, small oil and gas companies are historically mispriced. So right now we're buying small oil and gas stocks primarily because they're so cheap.
My guest today is Josh Young. Josh is founder and chief investment officer of Bison Interests, a hedge fund based in Houston, Texas. Bison invests in small oil and gas stocks in the US and Canada and owns several stocks that have multiplied many times over since 2020. In 2021, Bison's hedge fund rose 349% net of fees. Josh's view on oil and gas are widely followed in the press and on social media. I recently sat down with Josh and we talked about his outlook on oil prices and how he has found success by investing in small stocks that other investors have ignored. Josh, thanks so much for coming on the show. I greatly appreciate it, and I've looked forward to it for the last week or so because I've been following you for a while on Twitter, and your number of people who've been following you has just exploded.
Yeah, thank you for having me on. And yeah, social media is fascinating. I mean, I'm basically doing the same thing I did 2 or 3 years ago, except I would post something and one person might notice it 2 years ago. And now, especially if it's controversial, sometimes hundreds of thousands of people see it or interact.
Yeah, wow, it just exploded, and I just find you're a prolific tweeter. I see a lot of tweets at all crazy hours of the day because I'm usually up at some of those hours too. But I know you just had a baby, so that's why I saw one the other day at I think 3 or 4 in the morning or so. So keep them coming. That's really great. Really good stuff.
Yeah, thank you. Yeah, haven't exactly had much sleep in the last week or so. Hopefully this will be coherent.
Okay. All right, Josh, so you've been in the oil business, around oil or energy really, for a long time, right? For at least 7, 8, I think 10 years or so, or even longer. And I want to hear your perspective on this because you're a guy, and I always admire money managers, people, because they're the ones, anyone could say something about an industry, but if you don't have your own money on the line, it's a lot different. And you have your own money, your partner's money on the line, and you take positions, and you go big or go home, and you do a lot of research. So before we even begin, without even talking about any different companies now, because I know you do real deep dive research, what is the outlook? Now, well, let me rephrase. Talk to me about the supply and demand story of oil, because what I'm seeing is it just doesn't make sense. It's economics 101. It's limited supply, supply and increasing demand. But am I missing something here?
Yeah, so I guess just to get the disclaimer stuff out of the way, I'm the largest investor in the strategy that I run, and none of this is a solicitation for investment or a recommendation to invest in anything. You invited me on, happy to come on and chat with you and let your listeners learn more about the oil and gas industry and what I do. I I have a lot of money riding on this, and we've done really well. And so, it's one of those things where you look at something closely, and the better you do, the more there's sort of this weird opposite thing when you have your money invested versus if you're just an expert pundit where, the guys getting on TV that are just the paid consultants or the supposed whatever, they get paid to get on TV. They don't get paid to be right. And especially when it's really me investing and then other people sort of investing alongside me through this investment strategy that we run, it's just sort of a totally different dynamic. So part of why I'm up late is taking care of my 6-day-old. Part of why I'm up late is reading interesting data, chatting with people via social media or email or text or whatever in China and various other places, connecting with fascinating people who sometimes are only available at 4 a.m. Houston time or whatever. And so I think it's important to share. I think that's one thing that's an important filter when you think about where you're getting information from. The other is track record. And like you mentioned, I mean, we've done very well, fortunately, and done very well versus other sort of oil and gas stocks and indexes in a way that's considered statistically improbable, where active managers typically only outperform if they outperform by a small amount versus benchmarks. And Bison has done much better than that. And again, I think I think skill and analytics, they're very hard to measure and they're often ephemeral. And the starting point, we were talking about this before we started recording, with companies, and you look at management teams that do really well, and money managers do really well. And if the performance is good, that's a good starting point, I think, for identifying someone who may be more likely to have an insight. So I think it's important just to sort of baseline, like, hey, why should you listen to me? Why might I have a cogent argument in a space where everyone has an opinion? You ask almost anyone who's active in money markets or economics or whatever, and they'll tell you, oh, oil's going up or down, the dollar is going up or down. People have strong opinions, and I think it's a really complicated question, and I think it's really compelling here. So the way you framed it is reasonable. The problem is that oil can move a lot. Oil prices on the margin, like other commodities, and the marginal supply of oil driven by price is actually very inelastic. So if oil prices go up a lot or down a lot, you actually don't get a lot more oil supply in the short term. And the demand elasticity of price is also very low. So basically you end up using about as much oil if prices are high or low, and you end up producing about as much oil in the short run, whether prices are high or low. So it can go both ways. And that's part of why you see so much price volatility. It's also why, as an investor in the space, I pay such close attention to the macro, because you really have to have, so all this is a prelude to thinking about it, but I think it's important to sort of frame the question well, which is, one, like, hey, who are you? Two, what do you know? And then three, how do you think about this sort of really complicated problem to maybe be able to be more right than others on average over time? So the oil market is really undersupplied right now relative to a stable state global economy. We're not in a stable state. So there's bank failures that have happened recently. There's all kinds of disruptions post-COVID. China is still reopening. There's lots of complexities around the world that are sending demand in both directions, both higher than you'd think because of the sort of revenge travel from reopening and revenge sort of services consumption in China and certain other parts of the world, as well as what looks like a pretty bad recession already underway in the US and Europe, as measured by oil consumption and oil products consumption.
Okay,
and so
let me interrupt you a second, Josh. Let's
sure,
break this down. Let's talk about the supply. Now, I saw that for the past 8 quarters or so, which is 2 years, that capital has not been, from major oil companies, have not been being used for exploration and drilling, simply because of the political environment out there. And that is, and as you know, I don't have to tell you, I'm just telling our listeners, that once you stick a straw in the ground, every day you're getting less and less because you're draining that. You're basically taking that oil from the ground, and it diminishes. So you have to always look for new supply. We have not seen, and please correct me if I'm wrong, for the past 8 quarters or so, not much money has been going into exploration. Is that more or less right?
Yeah, so I think there's sort of the near term, like what's happening right now, and then there's sort of the longer term trend. The longer term trend is enormously bullish from a supply perspective because there's not been exploration. Forget the last 8 quarters. The last 10 years, there's been massive underinvestment in exploration. There's been a lot of development of very short cycle shale wells in the US and Canada and certain other projects that bring on a lot of production in the short term and then see very high decline rates from those wells. So they require a lot of reinvestment in order to sustain production. But the actual exploration activity that you need to do, so then you can delineate fields, so then you can go through and drill 1,000 wells and get 1,000 barrel a day initial production rate wells. That activity has been grossly insufficient. And so when you talk about insufficient exploration, especially by big companies, it's complicated. And recently there's been a decent amount of capital spend by especially large oil and gas companies, let's say in the last 2 to 3 quarters, especially after oil prices hit, let's say $130 a barrel last year, that there's been a step up in development spend, but it's sort of close to an inflation unadjusted number from the last top of the oil cycle from, let's say, 2010 to 2014. So you're not catching up from inflation, and you're also not catching up for the decade of underinvestment and exploration. So again, it's a little more nuanced. It's not like the rig count didn't double from the low to recent levels, and it's not in the U.S. And it's not like there aren't a bunch of offshore rigs that are starting to get hired and starting to get put to work over the next 2 years. It's a question, I think, of time frame and then order of magnitude. And I would argue, after how little has been spent for how long, you'd actually need to see, on an inflation adjusted basis, all-time high capital spend, and maybe you need to see that for 5 to 7 years before you get back to sort of a sustainably oversupplied market.
Right.
But
That's
again,
just to play. That's just to play catch up, right? We're really behind the eight ball.
yeah, I mean, maybe you need 4 or 5 years to catch up,
But
and then
it's not 1 year. It's substantial.
Yeah, it's really big. And I think, there's sort of the short term and medium term. Hey, what's happening in China? What's happening, from a demand perspective, from a supply perspective? Hey, what's happening with shale? What's happening with Guyana? What's happening in certain other, what's Russia doing? How much is Russia exporting? And then there's this bigger problem, like you're talking about, which is a real problem, and it's getting bigger every year while there isn't that spend. And then there's the other aspect that I think gets missed a lot, that we start talking about, and people, it doesn't seem to have resonated, which is very odd to me. But there's a giant hole in oil field services capital spend. So it's not like, you're Exxon, you're Chevron, you're Petrobras. You say, hey, I want to go develop a field. So you put out a tender to get the various oil field services to be able to go drill
Josh,
an offshore well.
Describe what oil services are.
So you put out this, you say, hey, I want to drill a well. Exxon's not actually drilling a well. Exxon is hiring Schlumberger or Halliburton to help them manage the project. And then those companies are hiring lots of subcontractors. Let's say it's an offshore well. Maybe they're hiring Transocean or Diamond Offshore, or one of these companies that owns an offshore rig, whether it's a drill ship that can drill in deep water or a jackup rig that can drill in shallower water. So you're going and as Exxon, you're hiring a project manager, typically one of the global top 3 or 4 oil field services companies. So Schlumberger, Halliburton, Baker Hughes, maybe Weatherford. And so you're hiring them to essentially help you manage the whole thing. And then they're your general contractor, essentially. And then you're hiring a rig, and you're hiring various companies to provide chemicals and drilling guidance. And if it's offshore, you may hire a submarine. It may be automated, or it may have, you may send divers down to ensure various aspects of the process. There's all kinds of, many hundreds or thousands of steps and technologies and companies and people who are involved in getting a single offshore well designed and then implemented, getting the drill ship out, let's say, and the site, defined, you want to drill in the right spot, and then you want to set up, typically you're setting up on the ocean floor, let's say it's 5,000 feet down or 8,000 feet down, you're setting up essentially a drill site down there, and you run the drill rig from obviously the surface, but but the drilling has to actually happen at the surface of at the bottom on the floor of the ocean, and you're drilling down from there. So it's very complex. There's lots of different companies involved and lots of different equipment. And so when we think about it and say, okay, well, let's say that oil majors should be spending twice as much as they are in order to sort of catch up for this decade of underinvestment. Well, even if they want to, they can't right now, because there just aren't enough viable drilling rigs to be able to actually engage in that activity. So what do you need to do? So right now, what's happening is a number of the offshore drilling rig companies, so again, the Transoceans and Diamond Offshores and Valarises and whatever, those companies have some additional rigs that aren't currently being used or actively marketed, that they call it cold stacked. In some cases, they warm stack them. So if it's warm stacked, they basically have it all ready to go, and they spend a little money to move it and a little money to reactivate it, and then they have to staff it and it's ready to go. Cold stack, they could have a bunch of the parts sitting in a warehouse here in Houston or, the UAE or various other places around the world, and they need to go spend, in some cases, $100 million or more, and in some cases a year or more, to reassemble this, let's say, drill ship, to be able to, and then re-equip it and order things from Drillquip or various other sort of equipment, or Forum, or various other equipment providers, to be able to get to the point where, let's say 2 years from now, after all this work done in planning and preparation by, let's say, picking on Exxon, by Exxon's team, as well as, let's say, Schlumberger's team, to be able to actually have a rig to be able to then engage in the drilling activity that's desired to, let's say, drill an exploration well.
So right now, even if they wanted to catch up, it's like building a house, right? You could own the land, but okay, I want to get a general contract and I'll hire the plumber, but if all the general contractors are busy and they don't have any more bandwidth, I'm gonna have to wait online, even if I want to build a house tomorrow.
Yeah, but it's a much more complicated process than a house, because again, there's very big, very expensive, very specialized equipment it's just so big and complicated and expensive. It takes months or years to get it. And then if you want to build a new one, I mean, one, you need way higher drilling rig rates, which means you probably need much higher oil prices. In order to make it economic. And the big companies, generally the Exxons of the world, are pretty good about not engaging in these projects unless they expect a high positive return, even in a lower oil price environment. So they need to be convinced that oil is going to be high enough that they can go face into all of these extra costs and issues in getting these wells drilled, and still earn a positive, substantially positive return that's risk weighted and time weighted and all that.
Let me interrupt you here. So you're telling me that we have, let's say, 4 years, even if we did this at full steam ahead, 4 years, just to catch up with the underdevelopment and underspending we've done for the past 10, and the replacement and all of that. Even if they wanted to go full throttle, there just isn't enough Schlumbergers, Halliburtons out there in order to make this happen. Is that more or less right?
Yeah. So, I mean, the general contractors, there's an issue, Halliburton and Schlumberger and Baker, especially during COVID, when oil prices went negative and then were low for a while, they unfortunately had to lay off a number of people in order to stay in business. So there's a people issue, but there's also an equipment issue. Right. The people issue is complicated, but I believe it would be it's going to be addressed via just enormous levels of compensation. So in the same way that, let's say, software engineers until recently were paid, let's say, $1 million a year by an Amazon or Google. I mean, I know a few of these guys, and they're very competent. They're around my age, around 40, but they were paid a price that no one could have imagined 10 years ago. Right. I mean, software engineers were not paid $1 million or $2 million a year, almost no matter how talented they were in 2010. But, they were paid that last year, and they were getting hired in a very tight market where there was just a huge demand for certain really specific skills. I think there's going to be that sort of same wage escalation along with other sorts of cost escalations across the oilfield services space as there's this ramp up. So I think the labor part is addressable via price. The equipment part is harder from a time lag perspective. You can get, I believe, the right people. You just have to pay them a lot because some of them are bitter, deservedly, for having been laid off at a bad time. Some of them are, employed by the Amazons or Googles or whatever of the world. Some of them are doing various other things or starting businesses.
That's a big checkbook, right? So that's a solvable problem. Yes. But in terms of equipment,
that's solvable.
There's only X amount of equipment.
The equipment's a bigger problem, and it's going to take even longer. And so that's, we have some investments in the offshore drilling space, more on the equipment side, some investments in the onshore drilling and completion space, also tending more towards the equipment. Again, I just think the equipment, there's this intrinsic lag. And then a lot of the fabrication facilities and shipyards and stuff are busy building other things. And, oil tankers, for example, their day rates are enormously high. So the shipyards are all busy. So you want to build a drill ship, that's nice, right? Like, even if you wanted to, which you don't because the day rates are too low, you need the day rates to double, and you probably need $150 oil before you start building sustainably for a while before you start building drill ships. You just can't, because the Korean shipyards are busy and the Chinese shipyards. I mean, it's just there's all this backlog.
There's capacity. There's a capacity issue. So you
And
can't.
then it'll take a couple years,
Right,
let's say.
right.
Maybe they'll do it real fast and do it in a year, 3 years from now. So you're talking 4 years before you have a ship delivered, and then you have to staff it and test it. It's just, and then you have to start drilling. And then, so, when you think about production, sort of incremental production from all of that investment and activity, you start to push. So you start to push that 4-year number to a 7-year number to maybe a 10-year number. And when you think about the complexity and cost of that sort of problem, you understand why it took oil going from 10 to over 100 and took 15 years essentially for the last oil bull market, and why I can look at oil having gone from negative to 130 to recently, what is it, 65, 64, something like that for WTI. I can look at that and say, no, we're not done. We're not even close. We're closer to the beginning than we are to the end. We haven't solved this big problem. So I think that's sort of there's a big supply problem, and demand's not going anywhere, and demand is pretty price inelastic.
Okay, so let's hang on a second. Hang on.
Sure.
So the supply side, we're still 10 yards behind. Even if we did everything you mentioned and had the capacity and had this, we're still not going to be able to catch up. And catch up we need to do. Okay? Now let's move over. So the supply, simple economics 101. Supply is limited to tight, to be kind. We'll use that word for now. Supply is tight. And it'll take some time to ramp up. And now let's talk to the demand side. Talk to me about the demand side, because you do some fascinating work with charting or following flights leaving China. Give me some insight into that. Why do you look at China?
So we do a lot of work on a lot of different demand and supply aspects. We just only talk about some of it, and some of it looks really good, so it's fun to talk about, and some of it is really important. And the flight data is great because it's free, right? It's from open source providers. So what is it, Radar Nav and Airportia? They provide this as a part of various other things, and it's really easy to see. And weirdly, last year, it was very contentious. Many people were arguing that China might never reopen, or that if China reopened, it somehow wouldn't have a material effect on oil demand. And so both of these to me seemed just nonsensical. There was just no world where I could see China just staying locked down forever. I mean, they weren't saying it, but also you could just see it was extremely unlikely. And then for oil demand not to rise from going from, let's say, 500 flights a day in China to 2,500 flights a day in China, I mean, it's just math, right? You look at how much jet fuel is used per plane, per essentially air mile, or per day if it's being pretty fully utilized. I mean, you could see essentially 1 million barrel a day potential uplift just in jet fuel demand, just from China turning back on to their pre-COVID level of flights. So it's a very interesting thing because it was weirdly contentious. It's still apparently contentious, which is just, I mean, people have lots of sort of politics and opinions and whatever about various things in the oil market. And part of it's just like not caring and just trying to have an objective take on whatever the particular nuanced aspect or micro thing is, right? So this is flights in China, right? Like my take is that China, like every other country, pretty much rebounds to pre-COVID levels and then sort of resumes at a demand growth trajectory. And there's a lot of data on prior disruptions for oil demand, and those are supportive of this view that it was extremely likely they would pick up. So what we saw was that flights started to pick up a lot from China. First, China to China flights, and then second, China to international flights. And oil bears have been pointing to just the total number of flights in China, saying, hey, this number is still really low, ignoring what China has said, which is, hey, we first turn on all our domestic flights, then we're starting to award visas, first to 20 countries, then it's to more. And I think one of the people I've been talking to over there, an expat at a big, I think US or Canadian company, I'm blanking on it, he was saying that his family is now allowed to travel to China as of yesterday. And so you couldn't book your flight until you got your visa, and they weren't giving the visas until yesterday or 2 days ago. So it didn't what you cared about is the trajectory, not the absolute number. And the absolute number has been rising a lot. The trajectory is very positive. But it's less about, I mean, I think that's a really important thing for, let's say, today's oil market and into later this year. But it's always about, I think, sort of the incremental question. So where else is there going to be more demand than people think? And then where is there going to be less demand, and similar to supply? So it's less about, again, those are very visually appealing. They're very easy because there's open source data that we can share without any sort of, copyright issues or whatever. We just tag the people that provided it and publish it themselves. But it's not that that's the only thing. It's that that's a very contentious thing, oddly, and that may be a material price driver over the next, let's say, 6 to 12 months.
Okay, but even further than that, we have just the development of countries like India, for example, and many of the other developing countries are going to be consuming more fossil fuels, more gas, more natural gas, more oil. So if you factor all of those things in, you have supply being crimped or catching up at best, and you have demand just resuming and then growing from that point. So I'm not talking about a week or two, who knows, that's randomness. But 5 years from now, could one make the case that oil prices, there'll be too much oil? I just don't see it.
Yeah, I think at some point there will be too much oil again. I think one of the things that my lived experience investing in oil and gas and then studying the full history of it, and you can see my bookshelf. I mean, I have a bunch of books that aren't up there too, but there's really interesting histories of oil. And what you see is that in downturns, almost always there are folks like this past downturn, like Cathie Woods, where they say, oh, it's going away forever, or, there's a permanent glut. And then, when there's shortages, there's people who say, there will be a forever shortage. And the reality is that it's cyclical, and that high prices lead to low prices and low prices lead to high prices. Right. And the reason to spend so much time and really belabor the supply chain issue and the underinvestment in exploration is that there's almost no price for oil. I mean, there's some price where you'd see significant demand destruction, but it'd be in the multiple hundreds of dollars a barrel. But there's almost no price where you get enough supply to meet likely demand absent a price that destroys demand. And again, because of the price inelasticity, you need prices to go wild, and especially in local currencies and emerging markets, you need them to just go so crazy like they did in 2008. $150 a barrel then works out, I think it's roughly 220 or so dollars a barrel now. And that's without factoring in refining costs and other sorts of issues and inflation and stuff. So those inflationary aspects. So you'd need much higher prices to really affect things. So I think that's why it's important to understand the constraints, because left to their own devices, the industry will overinvest and there will likely be oversupply. I don't know if it'll be 5 years or 10 years, but at some point there will be. But in between now and then, it seems extremely likely that there will be a significant undersupply and radically high prices to essentially destroy some demand or mitigate some demand, because that's essentially how the oil market works.
All right, so if I could paraphrase, we're really in the early innings of a bullish trend in oil.
Yeah.
Yeah. All right, cool. You put something out which I thought was really cool. How politics is getting in the way of smart energy policy. Could you expand on that for me?
Oh man, it's so bad. I mean, unfortunately, it's not even, in the US, it's not even a Democrat versus Republican thing. In Canada, it's not really a conservative versus liberal thing. There's just there's been this trajectory of NIMBYism where, not in my backyard, opposition to local projects and local development, pretending like oil from Venezuela isn't sustaining a communist regime that's brutally oppressive and isn't polluting beautiful rainforests there and lakes and all these other things. So there's real significant opposition. Unfortunately, it's bipartisan. And there's real significant opposition to development of natural resources across much of the Western world. And there's also some sort of utopianism that's trying to overcome math and physics. And there's a reality, which is you can't use an electric car to generate power. It's a consumer of energy. So when they say, these cars are clean, it's like, well, no, they took energy to make them,
Right.
and then they consume whether it's gasoline or diesel or natural gas or electricity, whatever it is. They're not generating it; they're consuming it. And then the supposed sources often also require a lot of oil in addition to coal or natural gas or what have you to extract whatever the resource is and then put it into a form that it's able to generate electricity, whether it's solar or wind or what have you. So there's some structural oil demand that I think people are just trying to pretend away, and that doesn't really work. And there have been some really interesting studies on countries that have high electric vehicle adoption rates and their oil consumption per
Increase.
capita.
Yeah.
And if we got to per capita oil consumption all around the world of certain of the Scandinavian countries, for example, that have heavily implemented electric vehicles, very high adoption rates, I mean, I'll be very wealthy. Like, we can't get there. There's just not enough oil
Without
in the
oil, yeah.
world to be able to get.
Right. I think I saw something in one of the Scandinavian countries, I forgot which one, where they were telling people, do not plug into the grid. The grid couldn't support it. I don't remember where that was, but it was the end of December. I remember reading it in Bloomberg or at the FT. But the grid couldn't handle because these grids are, as you know, ancient and they haven't been upgraded, and the infrastructure is not there. And we're plugging all of this and sucking all that energy out. And people think that when you charge your car, it's pixie dust which is going in there. They don't realize many times it's coal or some other fossil fuel that is generating electricity. Electricity just doesn't come from magic dust.
Yeah, well, for the electric vehicles, the oil inputs actually are more related to the battery and the various other car parts. So it's more the manufacturer, and then also the plastics.
Right,
It's phenomenal
right.
seeing people sort of imaginary, like the oil, like Just Stop Oil protesters who are wearing oil based products, use oil to get to their
Right,
protest
right,
sites and away from it.
and using
Um,
plastic pens, and
Yeah,
you
or
use
petroleum-based paint.
yeah,
I mean, it's
it's a
remarkable.
joke.
Like, try to do something without oil, and you have to learn a lot about oil, and you learn a lot about modern society and modern life. And the reality is that fossil fuels really make our lives a lot better, and we're not stopping using them, even when in certain places we force using less of them through government intervention. We just use more in aggregate because we shift the manufacturer of whatever it is that was getting manufactured locally to places that are less efficient, have fewer regulations and rules around pollution and stuff. So we pollute more and we get the same stuff. It's a real. I mean, I would prefer a cleaner planet. I'd prefer cleaner air. But the mechanisms that are used towards it are not really effective. And the people who say, "Oh, you need to stop," are frequently very large personal consumers of petroleum products. And so, I think it's sort of an age of hypocrisy and sort of this utopianism versus math and physics. And so I feel very good investing in companies that are helping with producing more oil and more natural gas, because I think we'll need it. And I think the people who suffer from having less of it are some of the poorest and least powerful people in the world. They're typically very poor people in Africa or India, where they're the marginal consumer of oil, where they, by buying a gas-powered scooter and being able to bring their crops to market or being able to get to work, they can cut out a 3-hour commute or something, and dramatically transform their lives by using a little bit of oil, versus the enormous amount that our environmental activists use in jetting off in private planes to go to
Yeah,
environmental
to tell the
conferences.
rest of us how we're not, not being, how we're using too much fossil fuel. What a joke that is. All right, yeah, it's just, just on a side for a second. We're talking about Congo and cobalt. The difference between making $1 a day and $3 a day is owning a moped, because transporting 20 kilograms of rocks, two or three of them, you need a some type of vehicle to do so, and the poorest of those people can't, and they have to take a very, very low wage, about $1 a day, while those who transport it just a few miles away, because they have the wherewithal to buy a moped or what have you, make more money than the people who dig for 12 hours a day. So I've seen every country that is more gets more electrified, electrification systems, infrastructure, have a higher standard of life. And far be it from us to tell people you don't want that. Of course they want that. Of course they want that.
You first,
Yeah,
right? Like you stop and then tell other
yeah.
people to stop,
But
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 don't,
but people forget that it's electricity, it's fossil fuel that allows incubators to run, have lights turned on for surgery, creates medicines, all of this stuff. And to say that they can't have it because we want to save the planet is just the wrong argument. I think it's more than hypocrisy. I think it's arrogance.
Honestly, I think ironically and sadly, it's racist and it's colonialist. And so
Okay, I'll
really,
go with
like
that.
when you think about who the incremental consumer is and you hone in on that, and I don't talk about this that much because people feel very strongly about it. And really, my job from a Bison perspective is just to find great investments that are really undervalued and buy them with my money and my clients' money and do well on them. But it's really, I mean, the people who have oil withheld because the price is high, or have natural gas withheld because various banks won't fund projects in Africa or what have you. I mean, it's really tragic, and I think there is actually a good that's done by investing in companies that produce through that investment incremental oil that helps affect the world supply. I think there are a lot of people who are going to suffer from higher oil prices over the next few years. And, on one hand, I will make more money. On the other hand, I would prefer that they suffer less. And one of the ways to deal with that is that I can affect that most directly is to invest in these companies and sort of facilitate more rapid development of oil and gas
Right,
resources. So I
right,
think
right.
it's truly a humanistic aspect. And I think it is a good thing to do to invest in these companies. And I think it's highlighted by focusing on that incremental consumer, right? When you see Indian oil consumption is near or at all-time highs, and you look at where that's going, and it's literally, like you said, the moped user. It's going to be someone in rural India, typically a farmer, being able to bring their produce to market, whatever that is, whether it's milk or eggs or rice, whatever it is that they're producing, and their quality of life improves dramatically. The price they receive improves dramatically if they can bring their produce to market versus selling it at essentially the equivalent of the roadside. And it's just a dramatic change in life for those incremental consumers. And how dare I or you or anyone prevent them from elevating their life from subsistence living to a little bit
Yeah,
more than
yeah, yeah.
subsistence.
I forget where I saw this, but 2.6 billion people in the world fuel their ovens with biomass. Uh, you know, wood, and cow dung, whatever it might be, and the women and children who are in this little hovel, they're the ones who suffer with terrible breathing problems and die much younger while the husbands are out working, what have you. And here, gas or electricity will change their lives. Will change just putting an oven in their house, in their hovel. But they're not even hooked up to electrical grid. They don't even have electricity. And here we are
Yeah,
talking about
or a propane grill or a whatever. I mean,
anything.
there's various things that could really dramatically change people's lives with minimal cost. And the problem is that they're either not allowed to, or the barriers to that are very
Very
high.
high.
And
Yeah.
so when you think about oil and gas investment, from my perspective, it's really just reducing those barriers for higher affluence for the poorest people, and everyone else sort of comes along for the ride because it's commodity. But really, it's sort of that marginal consumer, that incremental consumer, really sets the price. And that price is set based both on supply demand, but also just on availability. And it's really important, I think, to be able to allow that to be available so people can go from, if you burn wood in your single room house, you're going to live half as long or
Right,
something. I mean, it
right.
really
That's
destroys
right.
your lungs. You get all kinds
And
of
the
other health
children and
issues.
this, and
So,
just and also the pollution in the environment. It's just people don't get that. It's destroying, all that. Yeah, but definitely we're on the same page on that. All right, so supply and demand. We're in the early innings of oil. China reopening is just one factor, but that's a short-term factor. But you could see where that's going. Uh, uh, Politics is just clogging this whole system up because people just, I don't, be kind to them. They don't realize. We'll leave it at that. So when you're hunting, pardon the pun, when you're drilling down and trying to find a good investment, because bottom line, you're a capitalist. And I see behind you The Snowball, Warren Buffett, by Alice Schroeder, great book. You take a value approach to investing, and you hunt for great companies that are totally mispriced by the market in the small cap space. Share with us why you hunt there and not the large cap.
So I actually look at all oil and gas companies, large ones and small ones. Right now, small oil and gas companies are historically mispriced. So right now we're buying small oil and gas stocks primarily because they're so cheap. And there's different ways to measure cheapness. One is just on an absolute basis, measuring likely intrinsic value measured by likely free cash flow. People build these discounted cash flow models. I typically don't build free cash flow models. Occasionally we will for really specific purposes, but if it requires a model to understand that it's cheap enough to buy,
it's not cheap.
it's not cheap
Right.
enough to buy.
Right. That's what Buffett said. Buffett said if you have to think too hard about it, it's not cheap enough. It should be so obvious to you that you could figure it out in 30 seconds. If you can't, then
it's got to just be overwhelmingly.
Right.
And again, like it's not that we won't build models, but we're not building them to figure out if they're cheap enough. There's other reasons to do that sort of work. So there's another way to look at these things, which is based on replacement cost. So how much would it cost to recreate this asset? Right, to, let's say, for an oil field to explore, risk adjust the exploration success, to develop it, to get access to infrastructure, and then to have this profile of production stream with these operating costs and these royalties. What would it cost to do that? And then, what's the time cost to do that as well? Because, even if you decide you want to create a new oil field, you're going to take years of exploration and there's a lot of risk involved to actually hit oil. Or if you're buying an existing field that's not developed, there's a high price to go and buy it and then develop it. And so we find replacement cost is not something that people talk about too much and is very relevant both for producers as well as for oil field services companies, with their rigs or drill ships or what have you. And so one of the things happening right now is that you have these small companies. They're not just cheap on replacement cost, they're cheap on intrinsic value. So the likely cash flow out of their existing assets without, let's say, very much new production or delineation just out of their proved reserves. And then they're also, in some cases, very cheap relative to the current transaction market. So there was a company we talked about recently, or that we disclosed owning recently in West Texas, where assets recently have transacted around, let's say, 3.5 times run rate cash flow, and they were trading under 2 times run rate cash flow on an enterprise value basis. And there's some calculations you want to make
Let me
sure.
make this simpler for those who aren't finance majors or hedge fund managers. What you're basically saying is just you're comparing apples to apples and saying these two companies, one is trading at a multiple of, let's say, 4 times cash flow, and the other one is trading at a 2 times. The one 2 times apparently is much cheaper than the one 4 times. Why would that discrepancy happen?
So to be clear, what I was talking about, so that is also true. That's where I say the small caps are cheaper than the large caps. This one Vital, which I own and I'm not recommending, but using this as an example for sort of the types of things that we're finding on the small cap side. So they're cheap. Let's say they're at roughly 2.5 times cash flow at the current forward curve for oil and natural gas versus let's pick on a Diamondback or a Devon where they're at, let's say, 6 or 7 times cash flow.
Okay, those are much bigger companies.
Much bigger companies, exactly. But what I was saying was actually not that aspect. I was saying there are transactions happening where asset bases that are assets that are similar to the entire company of Vital Energy are transacting. Typically, with the people essentially come along with it. You buy the company, you pay out the bonuses, and then you try to retain the people to continue running it to the extent that they're necessary for those operations. Those companies that are getting bought, the private assets that are transacting at a multiple that's far higher than where Vital is trading. So it's not just that there's other
Excuse me a second.
companies,
Vital
stocks,
being a company that you own in your portfolio
yeah,
that
that
you're
I
not
own in my
recommending,
portfolio.
but you
But again,
using it as an example. So you're saying
using it as an
okay,
example,
so a
some of
company
these small cap
similar to it.
producers.
Let me just clarify I make sure I got this. So companies similar to Vital are being bought and sold in the private marketplace, or even being merger by a bigger company for X times, where Vital is comparable to it, but missed the market. The stock market is trading it only at half that amount. Is that more or less right?
Yeah, more or less.
Okay. Why does that happen? Why that discrepancy?
It's a great question. So partly because there haven't been many buyouts at premiums of small public companies recently in oil and gas. So the market just doesn't believe that they'll get bought out anytime soon at a price that's similar to the price that private oil and gas assets are getting bought at. So that's part of it, right?
So one part is, let's review quickly. Mr. Market doesn't believe that that company that got bought out or taken out in a private transaction, public company, maybe won't happen. I'm not going to give it that premium.
Yeah.
Okay, good. Second reason.
And to be fair, there haven't been many big premium transactions for publicly traded oil and gas companies in the last few
Right.
years. So
That's true.
it's
That's
not
true.
it's not wrong that that hasn't happened.
Right.
I think what's wrong about it is that there are a limited number of private oil and gas companies that are producing more than, let's say, 20,000 barrels a day of oil in the US, especially in West Texas. There's a very small number, relatively speaking, of those companies. And the valuations on those transactions up until this recent oil pullback in the last few weeks, but sort of the general trend over the last 2 years has been a move up in valuation from, let's say, 2 times cash flow on assets to closer to 3.5 times cash flow on assets. And so there is a trend. If I owned a private oil company and I wanted to sell it right now, my expectation would be that I'd sell it for around the price that the other guy got plus some amount, right? I'd always try to get a little more. So the last transactions I'd look at would be around 3.5 times, similar to, you're going to buy a house and you look at what the prices of the houses were in that area on recent transactions. So the comparable transactions indicate a much higher value than the public market is giving for some of these small companies. And yeah, there haven't been many premium buyouts recently, but that doesn't mean that there won't be. And in the meantime, if a company is on a positive trajectory, if it's continuing to add value, let's say it's paying down debt or paying a dividend or buying back stock or growing its production or some combination of those, the value that it sells at eventually could actually be
Higher,
growing.
right.
So, if you could sell for X, which is, let's say, 2 times your current share price, maybe in a year you could sell for 50% more than X. And then if valuations continue to rise, maybe you wouldn't sell for 3.5 times, you would sell for 4 times or 4.5 times. So there's multiple expansion on transactions and there's value accretion at these small companies. And so the combination of those sets up really nicely for when there will be more buyouts, but you also don't need buyouts of public companies to make money. The public market is ultimately a great place to realize value. And, it's just one of the ways to tell how much value there is these comparable private transactions to measure them and see sort of how cheap or expensive they are versus these public companies.
And small companies are just not as followed. I think the average of a company's under $1 billion. I think there are only 3 analysts covering them, and that could be a lot. And large caps have close to 22 or more than 20. I know that. So you have less eyeballs on these small companies, more price inefficiencies, and real opportunity. Would you agree with that?
Yeah, I think these days sell side research, so research analysts covering companies, as long as there's more than a couple, I don't think that's as much of a differentiator. I think the bigger thing is that there's been this move towards passive management because active managers do typically underperform, which is what we talked about at the beginning of this conversation. There's been a shift of investors over to ETFs, and the most popular are the large capitalization ETFs, the S&P 500 ETFs like SPY, similar ones in Canada and various, there's world market ETFs, and almost all of the money goes into the largest few publicly traded businesses. And so you end up, as there's more passive investment, which again, for most people, it's not a bad idea for them to, if you're a dentist or a lawyer or whatever, and you can make more money spending time on your main business, you might do better if you're almost definitely going to do better than trying to actively personally manage your investments without any sort of edge, just putting money in passive ETFs. The problem with that is that money all congregates in these largest companies. And the more that continues, the more outperformance there is available, especially in small cap niches where specialists like we are at Bison are able to find these really, really undervalued companies that have their own catalysts that are likely to revalue because they're buying back a bunch of their stock or they're doing something else that's sort of forcing the value up. And so it's really, I don't think it's research coverage anymore. I think it's sort of the investable universe for investment funds that are still active, as well as just this overwhelming fund flow of, exchange traded funds and index funds being directed almost entirely to large
Right, because
capitalization
they
companies.
can't invest. You're putting billions to work. You're not going to buy a $300 million market cap company. It's just too small. It
That's
won't
right.
move the needle, and they can't absorb that kind of money, right? So the money gets all clustered around, like it was FANG stocks, when everyone was buying the Nasdaq 100 QQQs and all. It's where the big money can go. It's not where they want to go. It's the only place they can go to, and that leaves a whole
Yeah.
universe for guys like you.
Yeah, and one important thing, similar to your question about the small caps, like, hey, what's going to change? How do you actually make money on these things? So, small caps versus large caps historically have shifted, where sometimes large caps do well and sometimes small caps do well. And when there's too much money on one side, essentially, of the boat or the teeter totter or whatever, you end up with there being extra returns on the small cap side. As that starts to happen, as you have, bonanza years like we did in 2021, you start to see money come in. And oil and gas is weird. And it's weird in the sense that the smart money, the institutions have promised to divest from the space. So normally what would happen is you'd have the university endowments and the pension funds allocating to hedge funds and mutual funds to be able to go find these niches and reprice them to buy these really cheap stocks. Because of some of the politics and because of it's a very complicated issue, but really there's money still leaving the space rather than coming in that would normally be arbitraging this. And that's sort of extending this opportunity, particularly in oil and gas, but also broadly. Small caps have done worse over the last, let's say, decade or so in the broader market, and it's likely that changes. And as money comes into these small cap ETFs, they're going to go into small oil and gas companies too, in addition to small tech companies and small whatever other companies. And so there's this sort of potential for a significant passive re-rate of oil and gas public equities as we have this sort of shift in assets from the S&P 500 ETFs to the, let's say, Russell 2000 or other sorts
Well,
of
we're
ETFs.
seeing that now. Small caps outperforming since I think it was July or August of last year, and we looked at some
Yeah.
work that had when the start of a recession, the next X period of time, I think it was a year or two. It was 1 year after the start of a recession. Small caps outperform large caps 11 out of 11 times since the 1950s. and we had a
I was not aware of that. That's really
yep.
interesting. What I do know for small caps for oil and gas is historically at this point in the cycle, let's say we're in inning, let's say two or three of a 9 inning bull market for oil and gas. Let's say two. At this point in the cycle, you would have small cap producers trading around 7 times cash flow. You'd have them at a slight premium to the larger cap publicly traded oil and gas companies for various reasons, right? The smaller ones are more dynamic. They're better able to do accretive acquisitions. They're better able to grow. They're typically more aligned where the management teams and boards own more of the stock. So generally you get a premium valuation for those attributes. Here we are
It's the
at
opposite.
roughly that part of the cycle, and we're at a giant discount.
Right,
And so it's like,
right,
okay, well, am I crazy or is this cycle
right.
different? And when you look at every other cycle for small caps in oil and gas, every other oil cycle, and just over and over again, you see the significant re-rating up in small caps. And this time, I don't think this time is different. I think this is just there's weird fund
It's just
flows
basically
right
it's
now.
delayed. You know, it's one of those things where you do your work and you look at your numbers and you say, I must have missed something. It shouldn't be trading where it's trading. It's something's wrong here, and we had that on so many stocks last year. We were looking at, especially in the microcap space, we were looking at valuations that didn't make sense. And I was telling my analyst, I think we missed something. He goes, no, we got everything in here. But and then they eventually, our thesis did play out. But you're spot on. Is that that especially now there are so many cross currents the way we see it in the energy market in terms of that have nothing to do with the fundamentals of the business or the fundamentals of supply and demand, but it has political, ESG, a whole bunch of factors which are just muddying the waters now. But eventually, it'll all play out the way it should be. That's just our
Yeah,
take.
that's right. And and this time really isn't different in the
Nope.
sense that, like you're saying, I think it's more about a lag. And the wonderful thing about lags is they give you the opportunity. I was a little frustrated a year ago. Hey, small caps, they're not re-rating. As I look at it now, as we deploy more money, it's wonderful. We get to go buy more stocks for a cheaper price than we should be able to. And the businesses are moving how we are expecting, and they're improving how we're expecting. Commodity prices, other than this recent pullback, are generally on the right trajectory. The supply issue is becoming bigger. The demand issue is becoming bigger.
Right, right.
So we're on sort of this right path. And there's like a discount sale on a flash sale, and the stock market, they say, is the only place where when stuff is on sale people want it
Yeah,
less.
yeah.
So it's
Yeah,
wonderful.
no, the way we see this is like, the sale was only for 10 days and now they extended it for 30. So you're going to be upset with that. But then again, it tries the temperament. It really measures the person investing because this requires the hardest part of investing, which, as you know, is patience, doing nothing, just waiting there. And usually it's been going the opposite way. And you say, this doesn't make sense. Most people would sell out at a loss and move on. But the smart investor, the intelligent investor, who knows, as a market knows, the price of everything and the value of nothing. And intelligent investors are just the opposite. If you see the valuation here, buying something at 2 times cash flow is not a bad thing, especially when you originally bought it at 3 times and the price went down. You're getting a better deal. So that's something
Yeah.
that most investors just don't get. But Josh, man, this has been really, really great. We got to have you on again, maybe another 6 months or 8 months from now, just to see how these things work out. Because I love your take on the energy market, on your knowledge of oil, and especially hunting in an area where the big money's not going, and that creates the huge opportunity in going to the small caps. And wish you continued success. And people could find you on bisoninterests.com. Highly recommended, folks, because he puts out white papers there, and I read some of his white papers. How much time and energy goes into this. I look at some of your white papers. You put in, gosh, these are term papers. These are research papers that you give away for free. So
Yeah, we this is just a fraction of the research we're doing. This is the stuff that we feel comfortable with writing up and putting out. And there's sort of a balance of, hey, like, what do we think matters, and then what are we comfortable with sharing? And so that's sort of that balance is that's the result of us balancing
and
those.
Josh, continued success. Lots of luck to you on the personal side and with your growing family. God bless there, and keep doing the good stuff and keep making money for your partners.
Thank you very much. I really
All
appreciate
right,
it.
man. Take care. Thanks for listening to this episode of The Charles Mizrahi Show. If you're a new listener, welcome. If you've been listening for a while, we're glad to have you back. Either way, we'd love to know what you think of the show. Please leave a review if you listen on Apple Podcasts. Reviews make it easier for others to find the show. You can also see the video of the interview on the Charles Mizrahi Show channel on YouTube.